Okay, I'd like to call a special meeting of the Kentucky Retirement System to order. And with that, we need the legal public statement. And Vicky, you're going to handle that?
Yes, ma'am. For the record, I want to note that this is a special called meeting of the Kentucky Retirement Systems. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statute Section 61.826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road, Frankfort, Kentucky. It is also being broadcast to the public via Facebook. I ask if you are speaking and not appearing by video, please identify yourself before talking. In the event the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date.
Thank you very much, Vicky. And Sherry, if you would do the roll call.
Yes, ma'am. Ms. Hampton,
Here.
Mr. Atkins, Ms. Bova,
Here.
Ms. Eves,
Here.
Mr. Lane, Dr. Miller,
Here.
Mr. Piercy,
Here.
Mr. Summers,
Here.
and Ms. Thompson.
Here.
Thank you.
And we have a quorum. And Sherry, do we have any public comment?
We do. We have received one public comment, and I will read it at this time. It is from a Mark Doran, and it reads as follows. I am a retired CERS member. My employer and I both contributed to a plan that was 100% funded during the majority of my career. Then the unfunded liability exploded when it was my turn to benefit. I totally understand the underfunding concerns and the necessity to address them, but our last COLA was 2011. No one can really expect retirees to live on a stagnated benefit forever. I understand the legislative responsibilities and the legislative actions regarding CERS in the past 15 years, the funding responsibilities and the CERS board relationship. In short, it's built a red tape system of no accountability to the CERS retirees. My question to you is, how do you plan to represent retirees regarding a cost of living adjustment? Currently, a COLA would require funding from the contributing participants, yet the CERS board has recently been decreasing contributions instead. Consideration should be given to options to tweak legislation for COLA funding or work within the existing system for retirees. The legislature won't move without your input, and we're depending on you to represent us all. What help do you offer us? An actual response would be appreciated. Mark Doran. Thank you.
Okay, thank you very much. I have texted Pruitt, and in the meantime, in order to move forward, Ramsey, if you would you take number 4, which is asking, I think we have 2 motions that'll go before us.
Sure. So the investment committee met January 18th, and Steve recommended 2 changes to our I guess objectives. Do you want to talk about them, Steve?
Sure. I'll start with item A here. So at the meeting on the 18th, staff recommended and the investment committee approved to invest up to $75 million in a closed-end fund strategy managed by Saba Capital Management, subject to successful contract negotiations. A little background, this investment would be part of our real return asset allocation and would be allocated proportionally across all pension and insurance portfolios. When fully funded, that $75 million, when that $75 million is completely called, the investment would represent approximately 1 to 1.1% of the plan assets and would bring the portfolios closer to their respective real return asset class targets. This investment would be funded by existing cash or the unwinding of proxy positions based on the specific needs of each portfolio. Staff believes this is a unique and compelling real return investment opportunity based on current economics, the drivers, and the risk return profile of the investment. As we've previously discussed, since the we moved the asset allocation. The last time the asset allocation was moved in the real return or real asset, we use those sometimes interchangeably. I apologize about that. That target was moved. We've talked about this asset class and the difficulty or the complications with increasing the allocation there. They tend to be less liquid, more private assets. And that asset class really encompasses a very broad and varied landscape of potential investments, as we've seen, both in the IPS as well as the varied investments that we've brought. So the most recent 3 that were approved were Arctos, Maritime, and Ceres, which farmland, barges, and sports franchise investing. So it's a very varied landscape. What we look when we look to fill the portfolio's allocations, we really look for investment opportunities with not only lower overall correlation to our more traditional asset classes in the portfolios like public bonds and public equities, but we also look for investments that are less correlated with the drivers of performance of those asset classes. And as we've talked about, the primary driver that we'll see, especially given the sizing of our public equities, public bond, is growth. So there's a very directional bias to our portfolios, very dependent on growth. And so we look for investments that have a diversified source of return. And we really believe that Saba, this specific strategy that Saba manages, offers a unique opportunity that satisfies our criteria for the asset class with a very differentiated source of return, asymmetric payoffs, and favorable standalone risk-adjusted return potential. So we're excited to bring this before the board for ratification. As I mentioned, the investment committee approved an investment up to $75 million across all of the pension and insurance portfolios. If we're happy to answer, I know in the appendix, there's all the material that was presented to the investment committee on this investment opportunity. If there's any specific questions, we're happy to answer those at this time.
Thank you, Steve. Does anyone have any questions? I just have one, if you don't mind. When I was reading it, if I had to almost say this, it's almost like they look at companies and say, keep doing what you're supposed to do, and then if they have problems, they litigate. Is that?
So there is a component of the strategy, and Anthony's on as well, and he can speak to that. But so basically at a very high level, there are investments that are called closed-end funds that were really the precursors to ETFs. And closed-end funds are daily liquidity. They trade in the open market on a daily basis. And a unique aspect of these is they tend to trade where there's the potential that they trade at a discount to the net asset value. So a discount, the trading price is less than the market value of the underlying assets. And what Saba in this specific strategy looks to do is to take positions in those closed-end funds and work with the investment company, whether that's on friendly basis or looking to enforce shareholder rights, potentially through litigation or negotiation, and close that discount. So if you have an asset, you buy something that's 15% below market value, and you are able to close that discount and realize full market value, essentially that's a 15% appreciation in your asset that can occur relatively quickly. So that's the basis of the strategy. I don't know, Anthony, do you want to add anything additional?
Sure, yeah, I think you did a good job about that. It's like, I mean, if it's just to keep it simple like that, like it's like buying $80 for 85 cents. But the thing is, everybody can see them out there. It's just because of the structure of the market is why it stays at 85 cents or maybe tomorrow 84 cents. And so it's one thing to just buy them cheaply, right? Because everyone can see it's that, but to actually get them to close the discount requires some actions, right? Because unfortunately, the incentives are misaligned, right? Like the asset manager is incentivized to just keep the fund going as is. They like the status quo because it's a higher fee product than of other funds. So, but I mean, these are baskets of, it can be tech stocks. So like one of the ETF, one of the ones they see closed-end funds they're looking at buying is, just the Magnificent Seven are some of the top positions. So you're just buying Google and Nvidia and things like that at a 15% discount. And others are, a fund of municipal bonds, which, you can value. Those are also listed. But because they're in this funny box, this priced at 85 cents instead of $1. And so be able to buy those and then take action to realize the underlying actual value of it is the strategy.
Anthony,
Thank
is it fair to say that this type of an investment is fairly ideally suited for a fund of our size? I mean, you're not gonna see BlackRock waiting in there, I wouldn't assume. But you got to be
Well,
big enough
BlackRock's
to-
on the other side. They're
Yeah.
one of the larger managers that has these products and is behaving not in a way that they espouse in their on the other side of their business with the ESG promotions that they have. Because obviously G is for governance, and not working in the best interest of all shareholders is not great governance. So
Yeah.
they're on the other side of this. Yeah.
Yeah, exactly. And we're of a size to take advantage of that inefficiency. But see,
Right. Yeah. And Saba is one of the larger players, but we're also not too
Yeah.
large so that, it'll still matter. We can we can invest enough to matter for us, but it's not something so large that other asset managers are going to come in. There's going to be a lot of competitors. So yeah, I think that's what you're saying, right, Dave?
Yeah, and I think to Anthony's point, it's a unique space, and as you look both at this investment opportunity as well as the recently approved. So for this asset allocation, you'll notice that we tend to size them in a manner that's kind of as a balance between it's meaningful. So it's worthwhile from both our perspective as well as from the performance of the portfolio's perspective. But as I mentioned, given the breadth of the asset class, we tend to want to diversify both from a manager standpoint, from a strategy standpoint. And again, this is the uniqueness of what we have in this bucket or this asset allocation is really differentiated drivers of performance. And this is something that's pretty unique. To Dave's point, I think the closed-end universe is still pretty large from the number of funds and the dollars invested. And how we're structuring this strategy is to allow the manager to take advantage of those dislocations. Again, their process looks for those discounts. So they wouldn't invest in necessarily in a fund that's only trading at a 5% discount. The opportunity there is not warranted, but they look for sizable discounts to the underlying NAV of the assets. And that's where they start to become active. And so currently, I think there's some charts in the deck that are provided on this. The opportunity is pretty compelling, both from an absolute and a historic standpoint. As Anthony mentioned, they'll shift where they're investing based on the opportunities that they have and the opportunities that the market is presenting. So we want them to have some flexibility in where they're investing. And we think that, again, there's lack of a directionality to it. So it's not dependent nearly as much on growth. The realization of that, what we'll call that alpha or that return potential, is not directionally based. I mean, the markets can go down and they can still realize that they're still able to realize the closing of that discount, which is performance for the systems.
Are there any other questions? Steve, we've got I think the people from Wilshire on the line. Would you like to introduce them to the board?
Sure. I think we have David and Craig on, I saw.
Chris as well.
And Chris as well. Sorry, Chris didn't. And they will. On item B here, they were obviously intimately involved with the asset liability and the asset allocation work. They also included in the deck is a preliminary one-pager that Wilshire put together for Saba. So that's included in the material that was presented to the investment committee.
Okay, well, would you like to start with B?
Sure. I didn't know if you wanted to take these one vote at a time or if you wanted to just collectively vote. So I'm happy to go ahead and jump into item 2. Additionally, sorry.
I think you should, because I think wouldn't we be out of balance if we didn't take B before A? And the
Well, so
IPS?
yeah, we can certainly do that. Item B, additionally, at the meeting on the 18th, staff in Wilshire recommended revising the asset allocation in the investment policy statements. And this is based on work that Wilshire's performed, the asset liability, as I mentioned, as well as the asset allocation modeling. And excuse me. So this recommendation was approved by the board. Sherry, if you could turn to the next page, please. Yes, thank you. Capital market assumptions, have changed really materially since the last asset allocation analysis was performed by the systems just about 2 years ago. And the return opportunities at that time were pretty limited, which forced a lot of pension plans to shift further out the risk spectrum in order to build portfolios that were expected to achieve their actuarial assumed rates of return. And the most notable changes in markets that have really occurred are the expected returns for fixed income and other asset classes with any part of a yield component. And that's as rates have risen sharply and rapidly from their former zero bound. So the last time we were looking at asset allocation work, rates were materially suppressed. We were still in kind of that ZIRP, that zero interest rate world. Fixed income, cash, and anything with a yield component offered, little in the way of expected returns. And that's changed pretty materially over the last 2 years. And these changes in the market conditions and expected risks and returns really warranted a review of the existing asset allocation and are providing an opportunity to construct efficient portfolios with, most importantly, meaningfully lower expected risks, higher Sharpe ratios, all while maintaining similar levels of expected returns and liquidity profiles, which is important for these portfolios. And these allocations really should help to mitigate the risk and potential magnitude of significant drawdowns in the portfolios should markets experience large sell-offs, while also improving the probability of achieving the assumed rates of returns of the portfolios over the longer term. So these on page 3 here are the specific target changes that were approved by the investment committee. And again, we have 2 different asset allocations. We have the top is the asset allocation for the KRS non-hazardous pension and the SPRS pension. Again, those have different assumed rates of return. And the bottom changes are for all of the other portfolios, which include the KRS hazardous pension and all 3 of the insurance portfolios. I did want to, if we could jump to page 40 and 50, sorry, Sherry, I just wanted to highlight some of the metrics and have Wilshire potentially jump in. Keith, did you have a question? We can answer that first.
Yeah, I do. I first brought this up, I guess, about a year ago, and I think maybe this is the proper time to bring it up again. It appears the suggestion here is to continue to treat SPRS as a similar fund to K non-hazardous, even though it is much more similar now to K hazardous in funding level. And I understand we also have an assumption issue there too, where we still have 5 1/4 on SPRS, but 6 1/4 on K hazardous. And I guess I'm just looking for what's the argument for continue to treat a fund that's over 50% funded in the same manner as one that's 16% funded instead of one that's much more like it, which is what K hazardous is.
I think we're up to 21, but okay.
I'm sorry?
I think it's up to 21% funded, but
Oh,
it's still
okay.
the same issue.
Yeah.
I certainly think that warrants a discussion, and it potentially, especially given the additional funding that the SPRS portfolio, the pension portfolio, has received, and whether there's also warranted distinction. So there was on the assumed rate of return a distinction made for the insurance portfolios that was effective at the beginning of this fiscal year. Again, moving from 6 1/4 to 6 1/2. And whether that dictates a different risk profile and portfolio allocation for the systems. We really base this primarily on, I think the part of the input that we take into consideration when we look at building the efficient portfolio, the efficient frontier for the portfolio, and recommending a specific allocation is the input of what is that assumed rate of return, which kind of gives us a risk profile. And whether that's, we could certainly build a portfolio for SPRS that was an efficient portfolio that was a higher risk, higher expected return portfolio. And again, I think if we look at page 40, Sherry, So the portfolio that was recommended is actually that in column lower risk X. And we can see what we've done is at this time maintained essentially the expected return, looking out at a 10-year horizon between the current target, between the current portfolio and what the approved lower risk X portfolio was, while significantly reducing, again, that on that standard deviation line, significantly reducing the expected risk of the portfolio. Whether SPRS, would be would warrant, given the change in funding status, especially with the additional allocations that they've received, a shift out, kind of that risk profile out the efficient frontier. I think that's a warranted discussion. But again, we really viewed it as looking at that input that we receive based on what the approved actuarial assumed rate of return is. It's what we used as input to kind of build the portfolio.
No, and I think those two things do need to go hand in hand, but I think that's something we need to look at the next time we vote on assumed rates, is if we have a plan that's now significantly better funded than it was several years ago, we need to treat it in the same manner as a like fund rather than in the same manner as a fund that's no longer anywhere near the same funding level.
Keith, I agree. I agree. And I think we've done a couple things working with legal. Is there's a bylaw change to the actuarial committee, actually giving them some responsibility. So I think if I could ask the investment committee and the subcommittee and the investment committee, the actuarial committee, to actually look at all the things you just said and come back to the KRS board with a recommendation. And that might involve our actuaries.
I would just add that we did the full asset liability study this time. So when you pull the liabilities in, that SPRS plan does still have elevated net cash draws, which would be a potential reason to keep it invested more conservatively, even though the funded status is improved. It's kind of sitting, but it still looks like a more challenged plan on a cash flow basis, at least, especially in the next 8 to 10 years, like north of 4%, whereas most of the other plans are below 3%. So that should be something that comes into consideration in addition to the funded status.
Yeah, I mean, that's a good point. I mean, SPRS is the furthest upside down as far as retirees compared to active workers, and it's always going to be that way. So maybe that is a legitimate argument for keeping it as is. But I think it is a discussion we need to at least have.
Yeah.
Fund is probably, I guess, potentially following budget approval and whether, what gets approved for additional contributions, obviously changes that profile as well.
Thank you. Ramsey, if you can take that note back to Pruitt and put it on the agenda of the two committees, I'd really appreciate it.
Sure.
Lynn, can I offer a comment?
Please.
Yeah, I think the cash flow issue is a legitimate one. But comparing to the cash flow of our other plans, they have gotten in such so much better shape, just generally, that they set a pretty high mark. But I think the legislature's done a great deal to provide those extra funds for us to get the contribution rates way down, to get the funded status way up. I think it's a good measure or a good message back to them that what they've done for us has really been, we recognize it, and if at all possible, I think Keith's right on spot on what he's talking about.
Thank you, Dave. And I think, again, I don't want to make those kind of decisions on the fly. And I think the actuarial committee and the investment committee, taking into account everything that we've had here, is the way to go.
Hey, Steve, let me ask you a quick question.
Sure.
Please, Bill.
Just when you look at the allocations, the cash allocations are a little bit different, I guess, in the plans. But this is an environment where we can get a pretty high rate on, cash. And one, I think we're going from like 2% or 5% to 2%. What's the rationale to decrease the cash position there based upon the higher rates available in this market?
Well, I think part of that, and Wilshire can weigh in as well. Part of that obviously is these are based on longer term expectations for returns for asset classes. And while currently elevated, and agree, I think we've talked about this at a number of investment committee meetings. While we've been comfortable holding, above actual range as we look to deploy capital to some of the asset classes where we've been underweight. We've been comfortable doing so because we've been able to achieve, I think our current liquidity program is yielding on a daily basis somewhere around 5.5%, which is a great position to be in. I think if we look out, on kind of the expected return over the 10+ year horizon, which is where we really look in the modeling, I don't think it's anticipated that cash rates will stay that high. I think this is, it's arguable how many quarters we're going to be maintained. I think that fight goes on in the markets in a daily basis with kind of anticipating the pivot when the Fed starts cutting rates and easing financial conditions. But if we look at normalization of cash rates, I think we expect those to come down. Whether or not there's a target to cash, I think given the frictional nature and as Craig mentioned, there's substantial cash flow just on a contribution and distribution basis from a percent basis of the assets. So maintaining a cash target allows us to effectively manage that. Whether for a period of time we would be on the high end of a range, taking advantage of what we would see as appealing cash rates. That's something we would look to do, and we're comfortable doing. We're doing it right now, and whether we draw that down and manage it, accordingly as rates come down, I think that's something we would look to implement.
Yeah,
Thank
just
you.
want to echo, Steve hit all the main points I think we would hit. This is a target for using projections over a decade. So we would expect over that time period, core fixed income gives you a better return prospect. So wouldn't expect necessarily the cash to immediately all be drawn and redeployed overnight. But looking at our assumptions, core fixed income has a 1% higher expected return over the 10-year period. So as you can see here in lower risk X, there is a significant shift into core fixed income, not just by reducing cash, but also by reducing public and private equity. So I think Steve hit all the salient points on that.
Yeah, thanks.
You're welcome.
Any other questions? Ramsey or Pam, do you all want to add anything from the committee?
I think that's pretty complete from my perspective.
Yeah, me too.
Okay. Okay, if there's no more questions, I guess we have two motions. We'd like to first have someone with a motion to ratify the investment committee's approval of the revisions to the asset allocation. Is there a motion?
So
I'll make
moved.
the motion.
Thanks, Keith. Is there a second?
Second.
Thanks, Ramsey. Okay, we have a motion and a second. And any further discussion? Okay, all those in favor, say aye.
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 Okay, any opposed? Or any abstentions? Okay, the motion passes. Okay, the second motion, if someone would make a motion to ratify the investments committee's recommendation to invest 75 million with Saba Capital. So is there a motion?
So moved.
Thanks, Ramsey. Is there a second?
I'll second.
Thanks, Pamela. Okay, there's a motion and a second. Is there any further discussion? Okay, all those in favor say aye.
Aye.
Aye. And opposed? Hearing none, the motion is adopted. And is there any further discussion for the committee? I want to thank everybody for being available for a special meeting. And with that, the meeting is adjourned.
Thank you very much.
Thank you.
Thank you.